Good evening, everyone. Good evening. Can you hear anything? I don't know if this works. There we go. Good evening, everyone. This is huge. Isn't this amazing, Jen? What'd you say, over 150 people? That's crazy. We don't get this many at the hackathon. This is crazy. And we could know that's true. And you all get more sleep this way too. So can I just toss this? Can everybody hear me? Oh, you need it for that? Oh, okay. I hate that thing. Good evening and welcome to our conversation tonight about initial coin offerings. My name is Joe Kleinrichter. I'm from a company called WorldPay, and for those that don't know, WorldPay has been for the last 3 years an intimate sponsor of the ATDC and a very proud sponsor of what the ATDC does. Over the last 3 years, we've seen some amazing companies grow up. We've seen companies like Andrews and others that have just prospered as a result of Jen's organization here and the work that they do for these companies. Tonight, we have a topic that I think is amazing. I've never before quite seen something get so hot with so few people understanding it. And I will admit, I'm one of it, because every time I read a description of it, I get a different view of what it is. It feels like the five blind men and the elephant, right? Describing something, and they're all right and they're all not. And we're all wondering about things like regulation coming up. We got to know something's going to happen. We know there's going to be a big story probably the next week or two, and the week after that, and the week after that. And even now, as I'm entering some companies, they're entertaining ICOs. And I had to go and read what it was. I knew what it was, but I couldn't understand the concept. And hopefully tonight, we'll get a good feel for that. But to lead us off, Jeff, where are you? Jeff Gapusan is our engineer in residence here or is it Catalyst? Catalyst here at Georgia Tech. So at ATDC, thank you.
Thank you very much. Good evening, ladies and gentlemen. My name is Jeff Gapusan, and I am the FinTech Catalyst at ATDC, which is the Advanced Technology Development Center. We are the state of Georgia's technology incubator, where we help entrepreneurs learn, launch, scale, and succeed. Tonight, happy to welcome you to this evening's panel, discuss ICOs, initial coin offerings. Stand by with me 1 second. Have our clicker. So earlier this month, as many of you know, CNBC reported that ICOs raised over $1.2 billion, surpassing angel and early stage VC funding fourfold. But before we get into what an ICO is or what they are, let's talk about some basics about it. The ICO is a funding mechanism that was first used in September 2013 by NXT. During that raise, the company raised about 21 Bitcoin. The equivalent then, $6,000 US. That actually was raised through 73 people, and while successful from a proof of concept standpoint, illiquidity plagued the offering. The advent of Ethereum and the ERC20 token standard enabled easier interchange, leading to greater liquidity and the use of smart contracts for additional features. Among those factors, this led to greater liquidity and popularity in the space. Cryptocurrencies and the blockchain have been intertwined since the conversation began in 2012. As valuations of Bitcoin and other cryptocurrencies waxed and waned, early stage investors and venture capitalists focused on the blockchain and its many other applications, including in financial services and healthcare. As you can see, we had some interesting peaks here in 14. This is when the significance of the blockchain and its applications rose. And it wasn't until early 2017 that we saw the rise in Bitcoin, passing $2,000, actually start to surpass the interest in the blockchain. So in early 2017, that pendulum swung, as we see. And this has coincided with about the time that ICOs began to take off. So in the span of a couple of years, the space transformed from one that was thought to be run by diehard, fringe, libertarians hell-bent on completely decentralizing the monetary system to one of high stakes in finance. However, if you can take a look at this chart, there's plenty of room for optimism. If cryptocurrencies indeed become a commodity, become a standard form of currency, market values show that there's runway for growth. In fact, the growth in the market has also cultivated plenty of opinions on the direction of the field. That also leads to create a two-sided market, which opens up opportunity for investors and entrepreneurs alike. You can now establish, monetize your beliefs. So without further ado, allow me to introduce tonight's panelists. First, we have Austin Mills from Morris, Manning & Martin. We have Sean Wilkinson, founder of Storj. Krista McFarland from Patientory, an ATDC Accelerate portfolio company. And Mitchell Kopelman from Aprio, formerly ATDC.
Test.
Yep. Cool. And we'll use these for the chat. So first off, I want to welcome the panelists and allow you guys each give a little bit of an intro and background for what your current businesses are and different fields.
So Austin Mills, I'm an attorney at Morris Manning, technology transactions attorney by background with a focus in FinTech and payments. So been working around the Bitcoin space for a while with various companies in there, but obviously that was a much smaller market than it has emerged, and so we were kind of waiting, being technology focused, kind of waiting to see what everyone was talking about, that how this thing is more than just Bitcoin, more than just the currency, and I think we this year we finally saw it, and that's largely why we're all here. And so it's become a fairly significant, the majority part of my where I spend time. I'm not a securities attorney, I'm not a tax attorney, I'm a technology attorney, so the firm has other people that specialize in that or looking at these issues. But I've learned more about those things in the last 6 months than I ever thought I would. This is presenting sort of new and novel questions that I think are very interesting. So excited about the growth of the space, the ability to participate in it, and see everyone here that's so interested in it.
Hello, my name is Sean Wilkinson. I got involved in the Bitcoin space in around 2012 and just fell in love with it. Ended up in 2014 starting my own open source project based on kind of the Bitcoin and blockchain technology, focusing on cloud storage, where I felt the technology could really be applied. Ended up doing one of the first token sales in 2014. It ran concurrent with the Ethereum token sale. Did that raise about $500,000? That's back when no VC would give me money. I'm gonna build a distributed cloud storage on blockchain tech and Bitcoin tech. They're like, Bitcoin, that's used for drugs and guns, right? So I was able to fund that through the crowd, through the community. Built that out, realized, hey, need to build out a business to actually get this in the hands of people. It can't just be an open source project. So started a for-profit company, raised about $3 million venture from that. Launched our product beginning of this year, and followed that up with, at the time, was the second largest token sale ever, about $30 million. Now that's chump change. And so have a lot of experience in the space, doing token sales to fund these types of businesses. So also shameless plug, if you don't get enough from this panel, I'm doing another one on the 31st at ATD.
Bring your questions, ladies and gentlemen.
Cool. Hi everyone, I'm Krista McFarland, founder and CEO of Patientory. We're the first global healthcare token for patient health information storage, and also the first cryptocurrency, in the healthcare space. So usually it's for finance. We decided to bring it over to healthcare with the permission blockchain. Background about myself, I am a healthcare domain expert. Been in healthcare over 10 years, been following blockchain Bitcoin since 2013. I was working for another digital healthcare startup, and our biggest problem was actually getting access to patient information. So I decided to marry the two worlds together, and I founded the company in late 2015. Didn't know I was going to do a token sale, but we were applying blockchain technology to secure patient health information and give access to patients. And we did our token sale at the end of June with a modest 7.2 million compared to the others in 3 days. So that was really, really exciting for us.
Hi, I'm Mitchell Kopelman. I'm with the accounting firm Aprio, formerly known as HAW. We have a strong practice in technology. It's about 18% of our firm revenue stream. We have about 80 people that are focused throughout the areas of technology, from tax to audit to assurance services, and looking at blockchain as an example of one of them. FinTech is a very large space for us. We've been working with companies in the blockchain and Bitcoin space for the last 3.5 years. And this year we've started to work with some companies in the ICO area. And we are in the midst of developing significant policies for companies that I can talk about when we get to sort of tax and accounting. I've been with the firm most of my career and enjoy what I do. So we love helping companies succeed, and this is the Wild West.
Thanks, guys. So it's apparent that the blockchain and distributed ledger technology have become a pretty relevant portion of each of your respective businesses. Now, the question often rises with certain companies: does a business looking to raise funds via an ICO have to have a business plan that incorporates DLT or blockchain technology?
I mean, ideally they should, but I've seen a whole bunch that have not done that and still raise lots of money. So ideally, it's a core part of their business, a core part of what they do. Not only for properly architecting the token and their business, but also now from a regulatory portion. If you don't have that, you can run into some issues in some cases.
Sure. Now, from a structuring standpoint, legal and as well as tax and accounting, for those businesses that may not have a blockchain or DLT portion of their business, are there suggestions that you would have with respect to if they're looking at an ICO in terms of, fundraising?
Yeah, I mean, I think like Sean was alluding to, at least from a securities law standpoint, failure to connect your token into some sort of usage, tends to push you more towards looking like a security and less like arguably maybe like prepaid access to a technology service, right? Which you could argue maybe something like Storj looks more like that than a security, for example. Go back to the original question. I mean, most of the time, at least in our experience, and Sean's probably seeing more of the market than we are, we largely see the clients that we work with and prospects we meet out there, but the ones that are coming without sort of blockchain as part of the business, it's just, I want an ICO, we're kind of shying away from, quite frankly, because, and I think the market, and I'd be curious to hear about the ones you're referring to that raised money through an ICO without ever actually having a blockchain use case in their business, but it feels like, they're just trying to show up at the party for easy money in a way that, this is already a sort of a, we're all operating in a gray area, and so we're avoiding any ones that kind of really want to push the boundary or aren't really maybe taking the thing seriously and are just trying to, buy in some hype where everyone will buy a token. And also, it seems to me, and I'm interested in you guys, that the market's not supporting those ICOs as well as it was perhaps 3 or 4 months ago. And so that, those models that are just trying to force the token as a way to raise money don't seem to be having that much success in raising money anymore. But
yeah, that's the fun part. It's somewhat of a self-regulating industry. It's like people see something that doesn't work, and like it's dead overnight. So, for example, you had the DAO, which raised all this money. They didn't do a proper security audit, and they essentially lost all the funds. And so people are really hesitant in participating in token sales that don't have a complete security audit. There's another token sale that did essentially kind of like uncapped kind of raises for tokens. We'll just raise as much as people give us, and that really created some perverse incentives. So now no one can do that. And these things are happening literally like, I'm talking to people one day, everyone's like, oh, like uncapped sales are probably fine. The event happens the next day, like no one can do that. So it's a very quick market, and it's very self-regulating market in some aspects.
Yeah, and then, in order to raise money, you have to basically persuade these buyers, purchasers, as to why they should invest money into your company. So while it may seem, yes, it's great to get all this money, at the same time, it's similar to any fundraise that you would do to a VC or an angel investor.
You still have a debt to somebody.
Yeah.
And that's your community, whoever's funding you. So.
One of the lots of stats out there about the companies that have actually done ICOs, that you have pending ICOs today, you have those that have been completed, those that are actually now trading. But what you don't hear a lot about is all the withdrawn ones, and these are the ones you're talking about that are failed. So if you look closely at and drill down into some of the different assets listed under the different blockchains, you'll see that quite a few have actually withdrawn. They haven't actually completed. And some of them, they said that we're going to have a minimum. If we don't hit it, we'll pull out. And some have just been withdrawn. A lot of these are the ones that they were trying to do in the last 6 months, what you could have done maybe a little easier with less of a business plan and less of a real connection to the blockchain a year ago. But the folks that are the sponsors have just gotten a little more tough about making sure that there is a real business and there really is a connection there. And that's why you've seen some withdrawal. You're not going to read about it. It's just not publicized that much. But if you drill down, you'll find a number of the ICOs that have been out there have withdrawn, quite a few of them.
There is a failure rate.
Yeah, I read last week, and I don't know if it's true or not, but yeah, that in the last month or so, around 50% haven't reached their minimum, either withdrawn.
Yeah.
Yeah.
But, a lot of these are, 2 guys in a white paper, or maybe half a white paper.
Well, I think the other component, there's a lot of noise in the space, a lot of people doing a lot of things, so, what might have worked a couple months ago doesn't work just because you don't get you don't rise above, the noise.
Now, in terms of structure, you bring up a good point. Are most of the offerings structured as best efforts, minimum hurdle rates, agency? How do you typically see those arise?
You mean the actual offer of token? When you
Yes.
say best efforts, you mean around-
Meaning if we raise $1 million, then $1 million it is. If we raise $750, then it's that, or
Yeah.
minimum hurdle rates of $3 million, all
Yes.
or none, or how do you typically
Right.
see that?
So from my experience, I've seen there generally is a minimum. The range seems to be fairly high between the minimum and if there's a maximum. Most of them there are at this point. And yeah, the minimum in theory should be, especially if you're using the proceeds to actually develop the project, you should set the minimum, presumably enough money to actually complete the product.
Yes.
And I think even some of these successful ICOs have been criticized for maybe not raising enough to actually carry out their goal. And so, yeah, I think it makes sense to structure it that way. I think not having a minimum and saying, well, if we get 10,000, we'll take 10,000, even though there's no plan actually. I think that's probably a bad look to the market at this point.
It's been kind of an irrational market at current, and so I've seen a lot of people talking more about we're not going to accept up to this much than I have seen people discuss about minimums.
Yeah.
But then again, it might be that a lot of the token sales on the bottom just haven't succeeded. So.
And I'm sure for many investors, having a robust secondary market for your coin or your token is probably something to think about if you're not hitting, certain demand structure. or
If your
demand
token's a
hurdles.
security.
That's
Yeah.
correct, and that actually brings us to the next question, which, Sean, you alluded to this earlier about the different types of ICOs. I've heard that companies can actually offer coins, utility tokens, tokenized securities, different forms of that. Are there any products that you think are, quote unquote, better or more suited to either the founders or those that may be, investor friendly? How would you categorize the different types of tokens or offerings that there could be?
So there's just so many ways to do that, right? There's, us who are working on like use tokens that have use inside of the network. I think a lot of people started out kind of in 2014, like when token sales started happening. It was, you just did a token sale. There was no distinction between particularly a use token or a token that's supposed to be an investment or whatnot. And then the space got larger, and kind of regulatory agencies started to kind of peer into what was going on in there. And there was, tokens that are very clearly securities and needs to follow, proper regulations, and there's others who've not. So there's been kind of a bifurcation in the industry, whether you're doing a securitized token, which is, for investment, follows all the securities laws, or you're doing this so-called use token, right, where it has a functional value in the network, doesn't necessarily promise returns or investment or give you everything that, investment might be. And so there's kind of this bifurcation here. What makes it even more confusing is sometimes you can have both. So for example, in the case that you have a use token, where you have not built the product yet, technically that falls under essentially security. So you can only market and sell that token to accredited investors before that token launches. So people will have these SAF notes, essentially, simple agreement for future tokens. And so that is a security, and that is in its own category, and then it later converts to something else. So,
Sean, would you say that's more relevant if you're selling to U.S. investors versus if you're selling your token outside the United States to non-U.S. investors?
yeah, so it depends. I think that is more relevant for
Because the SEC is really only governing at the
Yeah.
U.S. If it's a U.S. investor that's putting money into the transaction.
Although the U.S. does have a history of going after people outside of the U.S. who are not U.S. citizens that
Yeah, and
tangentially serve U.S. customers. So
the foreign investor exemption, I mean, again, not a securities lawyer, but I've sort of talked to ours about that specifically. And I think they really question whether the way, so was it Tezos or EOS that basically blocked U.S. IP addresses?
yeah,
And that was their way of blocking U.S. investors, never mind VPN routing
Yeah.
or whatever. And I think our securities lawyers thought that probably wasn't good enough to actually meet the requirements of the foreign investor exemption. And so I think some of the other foreign-based token sales,
Yeah.
blockchain capital or something like that, actually,
So-
restricted the number of investors. But there's obviously a heavy incentive to not have to do that, because part of the demand out there is being able to sell to the crowd, to the world,
yeah.
right?
And the regulation for it is there's so much going in that area. So many different jurisdictions, areas. I mean, for our token sale, you couldn't participate if you were in North Korea or New York. New York has some pretty tough restrictions in terms of tokens and token sales. So it's a new world, the way I see it.
But you didn't take money in from North Koreans.
No,
But he doesn't know that, right? He doesn't know
Did
that.
not accept that.
You didn't. How about Iran?
No.
Just keep saying no.
You know?
That was on the list.
I'm not sure. I'd have to go back in and look at it. But it's part of it is there are some real positive effects for having, clear guidelines around regulation, because there's clearly some bad actors in the space. But there's like the whole other side of that where like regulators are just like trying to put the cat back in the bag. It's like, oh, why should I go to this traditional route? Do like traditional security and all that kind of stuff, where I can just like fund this from my community and from the people who are actually going to buy my product. And why do I need VCs who are going to dilute me when I could take no dilution, raise 10 times as much money? So it's a wild world out there that we're all trying to figure out.
Sure, and it brings up a good question from an advisory and from the legal standpoint. How are you advising clients that are contemplating, ICOs in terms of the structuring aspect, given so many unknowns? Sean, you bring up a good point. You don't want to cut off your nose in spite of your face as you're trying to raise, plenty of capital that's out there and ready to invest.
Yeah, so I mean, the first conversation is always sort of making sure everyone's on the same page, that we're all doing a little bit of educated guessing here, right? I mean, you can go find, the biggest law firms in the world that have charts that say there's a 15% likelihood that this implementation of a token sale is a security. It's like, what do you do with that, right? 15%, and this one's 35, and this one's 70. And so, I think we've got some general ideas, and, we're trying to apply old rules to a new technology that doesn't fit in a perfect box. You know, Sean mentioned, for example, you know, having a usage token before the product is built, and I'm not ready to concede that that's necessarily security, but you know, there's case law about selling interest in a country club membership, and if the country club exists and can be used, not security. If it doesn't, then it is, and I don't know whether or not that doesn't seem like the right result, but I'm not the regulator. So, you know, it's kind of, you know, I think there's two sides of the spectrum. I mean, if you're the DAO, and that's where the SEC guidance came out on, that's very clearly a security. And not only that, and the SEC, I mean, I think maybe it's worth addressing that guidance in a little bit of specificity, because it's kind of the only, you know, substantive thing we have from the SEC. I mean, it's very fact specific to the DAO. The DAO, I think, was very unique, even perhaps
Is
next
everyone
to.
familiar with the DAO?
Yeah, sorry,
Here?
so-
Can everybody just raise your hand if you're familiar with the DAO?
Fairmont, you want to
Okay.
give a quick overview? You're probably better at it.
So, man.
He said yes.
So let me think about this. So there was these guys. They wanted to raise money for their startup, their product, and they felt the best way to do that was to build a platform for essentially decentralized investment. This decentralized VC firm that people could put money into this autonomous organization. And based on the money that they put in, they would get to essentially vote to fund XYZ product. The issue with that is that this was one of the first, it was still early in the days of like crowd sales and token sales for these kinds of ideas. It was still early in the Ethereum space. So they built this together, they kind of threw it together, they didn't do a proper security audit. I think when they did it, it raised about $500 million at the time?
Like 150.
Yeah,
Wow,
sorry,
150.
150. All these numbers keep on getting inflated every day. I have a hard time keeping track. So raised like 150, which is a ridiculous amount of money at that time. Again, they didn't do kind of proper security audit. No one really did that at that time anyways. And so someone found an exploit in this smart contract that allowed them to slowly start siphoning money, millions and millions of dollars, out of this contract. And so kind of end of the story there is the people running that network decided to say, hey, we're not going to allow that. We're going to fork that off, make a new, essentially Ethereum, and essentially give everyone their money back.
And that's what prompted the SEC announcement regarding potential investigation into regulating the ICO market.
So,
Right.
number one, because it crashed and burned.
Yes.
And they typically look at things that crash and burn. So if you do all right, everyone's happy. They don't look into it too much from what I understand. And the second part is that the way that was structured, that was clearly an investment, clearly a security, checks all the boxes on the Howey test, which is how we determine whether a token is a security or not. So that was an easy kind
Yeah.
of.
And not only
Good
that, I
for
mean,
them.
literally it's meant to be a VC fund.
Yeah.
And in addition to that, the SEC put a lot of weight, it seems, in their rationale on the parts where it wasn't decentralized, the parts where what's the name of that group?
Yeah.
But
seems
that the members of that group, even after it was, still acted as gatekeepers, right? So if it's a decentralized VC firm, based on your interest share, you can democratically vote on investments and, however the thing's designed to make those. But apparently, some very specific people tied to the sponsor were the gatekeepers. They vetted the first round. And so they were kind of acting as like a more centralized VC firm in their
Right.
behaviors. But I think it'd be really interesting if you take the DAO and the developer just made it open source, public domain, put it in the world, and then like four of us just put it on computers and just did it. Who do you go after? One other thing I think that coming out of that, so the takeaways from the SEC guidance are, one, we know the DAO's security. I don't think that really surprised anyone. I don't know how much we can take away with respect to sort of other models that are a much more gray area from that guidance, and we're probably going to have to wait for the SEC to weigh in more. I think another interesting thing that came out that not in the guidance itself, I believe, but actually the cover to it the SEC published, they mentioned their ability to go after the investors, which I'm talking to securities attorneys that have been around it for a while, said it was a very strange thing to say. Obviously, their mandate's investor protection.
You're gonna shoot the investor.
Right, and so I wonder if that was them sort of proactively acknowledging that we're not always going to have a person to go after in this
Yeah.
world, and we need to let people know that there's still accountability. But I also think it sort of signals that they might be a little bit protectionist and protecting their existing sort of, incumbents in this space, because, I do think this is turning into a real threat to VCs and PEs in the space, whether or not, they all want to say it.
So Mitchell, from the world of the audit, how do you protect your clients, whether it's your founders and entrepreneurs, when considering that structure or that, how that looks on the other side once that the ICO has been issued?
So I think what you're asking is, what does a financial statement look like if someone goes out and does an ICO? And so let's assume for a second that you have a company and your company does your ICO, which is not really what's happening in a lot of the ICOs, but that is something that you can do. So let's say you have a company and you start your company and you do your ICO. The money that you take in, it's not equity. It's not a liability, you don't owe it to anybody. So what is it? It's actually some form of income.
Ding, ding, ding.
Now, 4 years ago, when we were developing our own opinion on how to account for Bitcoins, cryptocurrency transactions, all the different types of transactions that people have been doing for a number of years now, there was no guidance out from the IRS. The IRS finally came out with guidance a few years ago. We were partially right, and well, I shouldn't say we were wrong or right. Part of what we developed ended up the IRS adopted, and then some other areas the IRS fine-tuned and said this is how you have to account for it. Now that didn't affect financial statements, that was for tax purposes. The same issue on financial statements, what's the guidance? We contacted the IRS, the folks that actually wrote the cryptocurrency tax policy, and we asked them, by the way, what are you guys doing about token sales, ICOs? We never heard of it. Never heard of it, okay? We contacted the American Institute of CPAs and another governing body relative to accounting for ICOs and the sale of tokens. We don't have any guidance on it yet. So we're developing what we believe is the right guidance.
So I think that's
And,
I just want to add, that's
Yeah.
the fun part. So like on the SEC notice, like that was like a year and a half later after it was like all said and done. Everyone got their money back. So the regulatory agencies are much slower in terms
oh
of.
yeah, they're gonna be very slow.
Definitely.
So on the accounting guidance, if you do your own ICO, we would probably take the position that it's revenue prepaid to you, what's generally referred to as deferred revenue. And for tax purposes, you might not be able to have it show up as revenue on your tax return for a year. For financial accounting purposes, it may be longer. It matters if it's a use token, and how is that going to be used, and what obligation does the company have over time to provide the mechanism where you could use that token. And so there may be, for some extended period of time, this liability that shows up on your financial statement called deferred revenue versus on your income statement revenue. The other theory that we're looking at is whether it's something completely different called comprehensive other income. And that is, it's not revenue, it's not a liability, it's not expense, it's sort of like it flushes into your equity. Kind of weird. Now that's if your company does its own token sale. But what if you actually set up a subsidiary overseas? Or some folks have set up foundations overseas to do these. Now the question is, does that company financial statement, is that part of your company's financial statement? It's a not-for-profit foundation. Who owns it? You don't own it, your company doesn't own it, has a board of directors. There might be some requirement to actually combine or consolidate those financial accounting results for your company, let's say here in the US or wherever it is around the world, and this third-party entity that you may have transferred some intellectual property rights to. And then the question is, how much IP rights are you transferring to this foreign entity that might be a foundation? And how is that going to be looked at with respect to some type of future exit? I'm sure on the legal side, you're looking at that to make sure that there's some type of licensing arrangement to make sure that the U.S. entity has rights so you can eventually sell this business one day. So I know that I may not have answered that very specifically, Jeff. It's a very complex area, and it matters what the structure is. And the structure, the question is, do you put the cart before the horse? In other words, it may be really fast to put a structure together to raise money a certain way, that may have a very positive or a very negative impact on your financial statements or your tax results.
And Mitchell, as a reminder, could you just remind everybody what the highest corporate tax rate in the U.S. is?
Well, today it's 35%, not including state
So on a
taxes.
$10 million token sale, that could be $3.5 million.
Well, but what might happen is maybe you raise $10 million today and you spend 4 of it this year. So you have left 6 to pay tax on. Then what might happen is the next year you might spend more money than you took in token sales. You might not do another token sale, and you might generate a loss, and then you could go back and get the taxes. But you'd have this problem where you actually come out of pocket one year for taxes and then have to claim a refund the next year. It's actually fairly complicated. So there are lots of different ways to structure the token sales. There are some different ways that some advisors have preferred to set up their structures. I think the situation would differ that whether you're doing maybe a token you sell or if it's a security or not a security.
I mean, that really is a flip side of this. You know, you don't want to be security until it's tax time. And that looks like a pretty good thing to be, right? But no, I mean that's a virtually universal dilemma. I think you were basically saying, you know, do I have enough faith in this sale that I'm going to spend a fair amount of money in a fairly complicated international structure, putting that in place to really mitigate tax burden, and then if the sale falls flat, and all of a sudden, you know, I've got all this debt that, or do I, you know, do the sale and then it's well successful, and all of a sudden, oh crap, I'm paying 35%.
Yeah.
So I think it's useful. We've been talking about, you know, the tax and the regulatory perspective. I think it might be useful to tie it back together and say, like, why do we do these token sales in the first place? Why do we go through all the extra trouble on, you know, completely blazing the trail in terms of like tax and structure?
Because it's free money, Sean. Isn't that
It's
so?
free money. You don't get
Some
diluted.
people
You
think
don't
it's
get
not
diluted.
free. I
It
can
is
tell you
not
that.
free money.
It is not free money. Two people have done token sales right here. It is not free
How about
money.
that? It's non-dilutive.
Non-dilutive, yes.
That's one thing that's helpful. So the way I see it, if you go like roll it all the way back, something like Ethereum would like never have been funded from like a VC. Like that would have never happened. I'd say for Storj as well, if we weren't able to do like that kind of initial token sale, just would have never happened. Just not had the resources to, you know, pay for a couple of ramen and some developers to like grow the thing and build it out. So really, these token sales.
Now you can buy ramen for the developers.
Yeah, in Bitcoin only. But like this new wave of funding allows you to fund these really out there technologies and platforms that would never be funded through traditional means. And the cool thing is that you actually get to be funded by the people who might actually use the token or the platform, who are a lot more interested in its success versus than, you know, a VC firm that again, like wants to grow and make a profit, but doesn't necessarily, you know, have a full sell on the vision.
What
Sure.
percentage of the quote-unquote investors do you think understand what they're actually investing in?
I would hope a majority of them,
Majority.
in our case. But
And
Which is
I
good.
think that would be, I think that, you know, in the interest of preserving some discussion,
Yeah.
you know, with the audience, we want to have some questions in a minute. We'll reserve that because I do believe that there are some investors. How many investors are here, or those that have invested either in early stage startups or in, you know, the ICO market? Okay, so we have a good number of those. So let's, you know, if we could hold off on those, we'll get through, you know, some of the last questions. Now, once you've decided as a founder or as a company that the ICO route is the route you're going to take, what are the things that these founders should be thinking of? What is the first thing that you did or would recommend that they do as they look to go to market?
For us, it was definitely, you know, you have to have a white paper, right? Most people think that, you know, white paper these days, it's not really relevant, but you really want to ask yourself why you need blockchain, why you're doing a token sale, and how this is going to benefit, you know, the growth and the scalability of your white paper. So that's the first thing that we actually did. And then after that, it's getting yourself aligned with like legal, tax experts. We actually set up our business in Switzerland. So now we're working with like the Swiss government and the greater Zurich area economy. So it's really looking at the key players to align yourself with that can really help you to bring your business from point A to point B, like any other business you would build as a tech entrepreneur.
Sean?
So I'm going to tell you the things that other people won't tell you. So the first thing that's the unorthodox tips for a token sale, make sure you sleep and like eat well a lot before the token sale, because you won't have time to do that while you're running and doing 18-hour days to make it happen.
You'll literally be up at 3 a.m. in the morning fighting off like DDoS and people trying to hack into your system.
Yeah, that's a fun ride.
Yeah.
The secondary thing, which I don't think a lot of people say, is like I'd actually recommend raising equity money before you actually do a token sale. That way you have a little bit of resources going into the token sale, because you need to pay legal and tax and accounting and all these guys money to do things kosher and do things proper. So I see a lot of people falling trap, like, I'm just gonna do a token sale and like we'll do like an entity later, and like no, it's like there's a little bit
Don't
of
do that.
Yeah, yeah, don't do that.
That's how you
Wait
go
a minute, you
personally
guys get
bankrupt.
paid for
Exactly.
doing those things?
Oh no. Of course not.
Now we're just trying to convince.
We'll know
all
we
the
get no upside.
So we're trying to convince all the service providers in the space to actually accept the token.
If I ran the law firm, we would. I don't, then we don't.
Well, actually, our accounting firm about 3 years ago did sign up with BitPay to be our processor to receive Bitcoin for services. And I will
We
say
didn't
get that.
today, a client in the room actually asked if they could pay us in Bitcoin. It's like, that's the first client since
Oh,
we've been
really?
signed up on BitPay that actually wanted to pay us in tokens. And I couldn't find the link on our website, so we'll get that to you.
So that's great. So in the interest of having some time for Q&A, we're going to pass around the mic. So if you guys have some questions for our panel, please raise your hand and Lauren will have a mic for you and we'll get that to you.
Yeah.
Hi, guys. Can you hear me? How do you decide what amount to set the token at? As
What do you
far
mean,
as
the
how
cost?
many
Oh,
to
the cap.
print, how many to create?
And this actually was one of the questions that was going to come up was, with traditional investments, you typically have a treasurer or a CFO, somebody in the CFO suite that will say, we need to raise X amount of money. With the digital currency kind of market skewing the amounts that are being able to be raised or justifying the amounts, do you have somebody that tells you this is what the digital currency market looks like, this is where secondaries are trading? How do you evaluate exactly that? How much will you set as your minimum hurdle or your minimum raise?
For us, it was our minimum was 250,000, and that was based on our, we had a financial plan as to how much resources, capital we would need to actually build the technology. So it's just similar to, when you go out and raise a Series A or a seed round, you kind of have those numbers to show as to what you're going to be doing with the capital in like a 2 to 5 year projection. Yeah, our maximum was 9.1 million.
So the question was there a maximum that was set up?
Yeah, so we did have a minimum, and then we had a maximum as well.
Where'd you get the 9.1 from for the maximum?
So that was in that 5 year projections that we did.
Questions?
So I'm sorry, can I just ask a follow-up on that? Why would you have a maximum?
Because in the industry, people aren't happy with essentially
Uncapped.
uncapped token sales.
And
And so it's like a huge red flag.
But even in traditional fundraising,
Yeah.
it would be pretty common to have a maximum fundraise goal.
If you think of it from a securities or a market perspective, if you have demand that's met completely, there is no really secondary demand, which then the price action on that will fall. You don't leave any money on the table. However, you don't have any support on the after or on the follow.
Yes. What do you do with the money? The question is really about funny way to ask that question, but really the question is, you have some stewardship of that money. It's supposed to represent maybe some assets or some value to, the person, the investors. So when you decide on what to do with the money, put some developers in creating a product or setting aside some money for future work, et cetera, what's the thought behind, what you do with the money?
You want to take that, or you want me to?
Chris, you take it.
What do you do with the money? I mean, again, it's going back to your projections, right? So, 12 to 18 months, you want to grow your team to about 15 head count. It also depends on what the stage you are with your technology. So you have your product roadmap. That's also a requirement for issuing a token sale. So most investors, or all investors, they want to see you with a product roadmap, so they know within that 90 days that you're hitting the ground and you're building and you're working, and they can expect something within that time frame with the proceeds that you've raised.
Well, let me just add to what Chris has said. I mean, at the end of the day, of course, you didn't raise money in the form of debt or equity to third parties. But the question is, do you, as a executive of this company, have some liability? Maybe liability is the wrong legal term, but do you have a responsibility as the CEO, as an officer of this company that actually sold tokens, that actually received millions of dollars? Do you have a responsibility to any third parties? You may not have to have an audited financial statement to give to a shareholder, but now the question is, you have requirements to have some financial reporting. You have obligations.
Yeah, so
And you're responsible. It is other people's money, so there are rules that are written and there's rules that are unwritten.
I mean, it's become best practices in the terms of token sale to disclose use of proceeds, right? And from a legal standpoint, it makes us feel a little bit weird because that's something you normally do in securities offerings documents, while, these documents very clearly 17 different ways say this is not a security. But, that has become best practices, and so, if you didn't sort of follow through, there might be a contractual breach claim. As far as a fiduciary duty, as of right now, and again, this goes back to, we don't have a logical framework to put all this in, right? This is a brave new world. So, you have fiduciary duties to shareholders. These are not shareholders, right? And if you want to put them in a box and you want to put them in the buying access to a product, literally a piece of software, a token is that it is your key to use the service, then, you do whatever you want with the revenue. Quite frankly, if you put in use proceeds, we're going to take 90% and we're going to go party for the next decade, and 10% will leave one developer back in the room to try to build this thing. You could probably do it. People won't like that.
Read the token sale terms. In ours, we try to, be as transparent and really kind of set the standard in terms of disclosure. And so there's clear lists of use of proceeds in our terms. But I've started to look through other token sale terms, and they're just thanks for the money, we'll do something by maybe some, whatever. So the text is important. A lot of people just click done, put the money here. But if you start to read into some of these token sale terms, maybe they'll tell you a little bit more than that's on the surface.
Yes, gentleman in the front row.
Hey guys, so my question is related to something Mitchell you asked earlier. It's about the timing and the need for even doing an ICO. So we recently saw Filecoin do this ICO, raise $250 million through accredited investors. Now the point is that they actually don't have a working product, right? So something, Sean, that you brought up before, do you focus in this market, do you actually focus on building a product that at least has a semblance of real world use case? Or do you focus on the hype and marketing and getting the right team together, perhaps, to do an ICO? Which comes first?
So the funny thing, if anyone didn't get that context, Filecoin is also working on distributed decentralized storage. Like I am storage. The difference is we have a functioning product that's on the marketplace now, and they don't.
And they raised $250 million.
I think it's still open too. So it's definitely.
By you, and then
We're not selling. So it's definitely an interesting new market where don't really know all the answers and the timing of the market. You know, ours is like, hey, we launched the product. We want to grow this. Let's do a token sale. We want to move from the Bitcoin counterparty platform to Ethereum, which is clearly where like their ecosystem is going. So it made sense for us. I think in other cases it's like, hey, this is the only way to fund this really great idea. In other cases, like they want to build out, you know, not only just like decentralized file storage, but all these other things. I mean, they want a lot of funding to do that. So it's kind of, I'm not sure if I answered that question, but it's to each their own, right?
Well, if you look at the crystal ball and if you see where the world is going,
Yeah.
where's the hype? The hype is you can make hype out of anything.
Mhm.
And then there are people in this industry that are doing that.
Yeah.
Those are people who are working on developing a real product that will work in the real world.
Yeah.
So where do you invest your energy now?
Yeah, and I will add that having the product, as Sean alluded to earlier, can have positive securities laws implications as opposed
Yeah.
to going out without
The
it.
most positive.
Yeah.
You don't pass the Howey test.
If you, yeah.
Yeah.
I'm not going to concede that yet, but yeah.
We have 2, 3, 4, and then 5.
So would starting the nonprofit or the corporation in Switzerland or in an overseas capacity, is that just done for tax reasons? Or is that more regulations reasons because the regulations are catching up slower?
All of the above.
Yeah.
And people will do it for all sorts of reasons. Some
I
on the
think-
tax side, some on the.
I think Switzerland specifically is
Yeah.
primarily taxed. I think we've got like
Yeah.
14% corporate tax rate, one of the
Yeah.
lowest in the developed world. But yeah, you see a lot of Asian activity that's I think largely, you know, to get out of the U.S. securities framework and things like that.
So one question would be, so you're seeing a lot of like ICOs being happening on the like Ethereum platform because of the ERC20, you know, the rules and regulations. Let's say some other alternate coin platform, Litecoin or someone brings up their own sets of rules. So do you think that would reduce the value of Ethereum and then ultimately reduce the value of your token sale? Or like if you have multiple competitors for that same developing their own set of rules, do you think it decreases the value of your, I mean, how do you look
I
at
think
it?
I kind of got that question. Could you?
Let
I think
me
that-
see if I could, let me
the
see if I
addition
could
of-
take it, actually have, I thought that question, something like that would come up. So, you know, you hear a lot about Ethereum. You hear a little bit less about Bitcoin relative to blockchain, but do you know how many blockchains there are? There's about 80 blockchains.
At least.
There's 72 of them have just done their own offering. And then there's a few of them that have done 2, one that's done 3, and then you've got 11, Bitcoin's 13, blockchain is 50, and Ethereum has got the most of them, it's 183. Those are not all necessarily the completed ones, but statistically, that's pretty much what's coming out. I mean, most of them have done Ethereum, 183 out of 344 assets listed. Some of those have withdrawn, some are pending, some are trading. You know, there's about 47 trading. So which blockchain you go into, you have to look at statistically what your use case is and where the risk is and where you want to get the risk. And I mean, but you can form your own blockchain tomorrow if you want it.
Would not recommend. But you can.
You can.
Yeah.
I mean, there's
Ethereum-
72 that have done their own just all by themselves. They're waiting for people to participate in their
Yeah.
blockchain.
I mean, and some are built some are built to be platforms. Some are
Yeah.
built to just be an implement. But I mean, Ethereum has competitors, not nearly at their size, right? But you know, Stratus, Misco, isn't that a
I
platform?
mean, a lot of those are like protocol level
Yeah.
things. So you'll
They have
have
their own
think it's like
blockchain.
clearly this one is better for this, this, and this, and this is better for this, this, and
Didn't
this.
EOS brand itself as the Ethereum killer while it built on top of Ethereum? Is that?
Yeah, something like
Oh,
that.
yeah.
Um,
So, I mean, who knows? I guess, right? Whether you know, what kind of staying powers Ethereum have as the primary platform for this type of
it
development.
has network effect.
Yeah,
You
the
can say
network
that.
effect. And I mean, I think network effect we haven't really talked about is really important in this space. And it's, you know, for a long time, I'll admit, you know, even being around it and being in technology, I was always, you know, oh, Bitcoin's really cool, but what are the odds that the first shot at that was the best thing we're going to come up with?
Yeah.
Won't someone just improve the tech, add some functionality, and all of a sudden, well, why are we using Bitcoin in this thing? But
Yeah.
the reason that Bitcoin is stable and presumably sort of trustworthy and, arguably has a very strong likelihood of being sort of the big crypto in the room for a long time to come is because of the network effect, because of the community, because of all the investment and the vested interest in supporting it, and all of that creates, staying power and value, and, in a way that we don't necessarily think about currencies and ecosystem, commercial ecosystems in that manner. I think, you can kind of analogize like a social media network, which I think is somewhat low-hanging fruit for blockchain tech. And one of the bigger projects out there, Steam It, is kind of like a blockchain-based Reddit, and the value is really in the community and the eyeballs, and that makes sense in a social media world. But I think this, for similar reasons, it makes sense across a lot of the blockchain space even more broadly.
So from an investor standpoint view, what does an exit or liquidity event look like? Like once I pitch in on an ICO, what is my return? When does that happen? I mean, I assume it's different if it's security or a use token, but like what's the incentive for an investor to hop in on an ICO round other than they're just really pumped about the cause and want to give you some cash?
I mean, for starters, on most of these, you'll be able to get out a month or two later, right? So unlike a lot of, more private, early, credit, registered or exempt securities offerings or P-type VC investments where you're sort of locked in for a long period of time. I mean, if you bought in the Storj ICO, you guys,
Token sale.
yeah, sorry, sorry.
Try to-
Token
To
sale.
try to
Rebrand.
like securities language and like
Right.
use tokens.
So
right?
token sale. How much longer before you guys were on Bittrex? And
I don't know, like
a month or two. So I mean,
there's-
there's
There's
Yeah.
40
liquidity for investors pretty much.
Out of
immediately.
129 that are deals that are over, there's 47 trading today. Does that sound right to you? That's
Sounds
stats
low.
we pulled.
I think one thing to point out too, in terms of valuation also, at the exit, with the tokens, an investor is immediately able to flip in securities terms, their purchase. However, if you take a look at some of those trading charts, what you'll find is you'll have a spike in volume, and then if you had, let's say, half of the offering, your ability to get out may be hampered by how much volume actually trades on an average daily trading volume. So, whether it's on, the Bitcoin blockchain, Ethereum, Steam, the supply and demand still works for the market as it does whether it's an equity, fixed income security, or any other type of security, even though it's not per se a
In
security.
Yeah, that-
Ethereum, you've got an ecosystem essentially that's been created in a short period of time.
Right.
Well,
There's
that's-
the equivalence that's there, whether you're trading Patientory coin, Storj coin,
Yeah.
any of the other different coins, and you can go from, one to the other via that Ethereum.
Yeah,
or
so
that Ether.
we attribute the value to kind of the utility in our ecosystem, the utility of the token. So, we're trying to tackle, $20, $30 billion cloud storage market. The only way we can do that is through kind of this token that kind of allows the mechanisms in the system and protocol to work. So if you were to kind of like bring it down, there's, that brings utility and actual like functional value to the token. So it's like, the silly example I use, like you have a bunch of Chuck E. Cheese tokens that you use in our protocol, and that's the only thing you can use in our slot machines or our games. And so those still have some functional value, so you can go sell that to somebody else, almost instantly, if they want to use that ecosystem, versus, again, the more traditional, you invest in a company, in a security, it might take, 5 to 7 years, before you actually get any value out of that. So,
One of the examples I like to use or try to, think about what some of the earliest forms of digital currency, airline miles.
Mhm.
There is an equivalence that's there. It may not be what you think it's worth, but however, there is only one market maker, and that's the airline. Right?
So you can resell those.
Correct.
You can buy and sell them on the open market.
Oh,
I mean,
yes.
it just,
Right,
Yeah,
right, right.
yeah.
which is actually similar to tokens.
Right.
So there, the secondary market
There is a secondary
It may
market.
be thinner than you would like, but
It's
it is there. And we'll take one question, then the last two gentlemen had the last.
Sean first, and then if anybody else wants to add. Okay, so sort of the broadest accepted conventional wisdom is you should be using an ECR20 coin, you should have a security audit. Can you take it to the next level without writing the book on the ICO thing? Can you take a minute or two and just break those down into a little bit more detail and from an architecture perspective, the key components of the audit, to set it up so it works well and protect yourself.
So this the ERC20 token and the security thing,
Well,
or do you want me to expand?
Or anything else about the technical aspects of implementing the ICO offer.
So I'll talk a little bit on the token side, because I think that's where you're asking on the technical side. So for when we first did our first token in 2014 on the Counterparty platform, it took me all about like 5 minutes to create the token. It's kind of easy, but that didn't ultimately end up being scalable for us to use what we needed it for. So in this year, we switched from Counterparty. Counterparty is just a protocol on top of Bitcoin that you can use to create tokens. And it was a dominant token platform for a while. Ethereum and ERC20 tokens are now the dominant standard, so we switched over. It took us, like a couple months and like multiple people to like build out that ERC20 token. So there's standard frameworks that you can use for that, but if you want like extra features and whatnot, there's a lot of work that you need to put on top of that to make sure it works properly, to integrate into various different things. And the other thing is like understand it yourself, because Ethereum, while it's perceived as being very simple, there's a lot of technical complexities that you need to understand. And then from there, we had a security audit from Smart Contract Solutions, which I consider hands down the #1 in the space. Smart Contract Solutions. So highly recommend them for doing a security audit. They did ours. Did they do yours? Or
They did not.
They did
We
not. But they've been
had-
helping you with a couple other stuff.
Yeah, but we had our audit done from
Yeah.
someone in Argentina. I don't remember
Yeah.
their name, so.
So yeah.
It worked,
Yeah.
and we passed, so they're much cheaper than smart contracts.
Yeah,
So if you want that contact.
Yeah, for me, for the security audit, it's pay the money. You don't want to end up like the Dow. So that's my
We'll take the
advice.
last two questions, then we'll,
So,
have some time to
Sean
go.
and Chris, you mentioned paying your developers in coin. Do they consider it a liquid? Can they convert it to cash or whatever? Is it liquid or a liquid payment for them?
So that's a little bit harder when you have like these newer token sales where there's like
You're at the
zero,
bottom.
yeah, you're at zero liquidity. It's easy for somebody like us that's been in the space for a couple of years, and there's like actual market for storage. So we love paying service providers and storage token. So I think it's a bit of a different experience for myself than other people. I don't know about you.
Yeah, I mean, I've offered our PTOY tokens to developers, and they've happily taken it. So it all depends.
I mean, people have different risk tolerances as well. Some people are like, fiat, I don't want that. Just pay me all in tokens. People are a lot more likely to accept like Bitcoin and Ethereum and as payment, and then obviously have cash. So. But people are starting to slip towards crypto. I've noticed.
So I think-
instead of cash.
One question that's interesting is, what both of you guys think? I've read a lot about different thoughts on, so you raise money presumably in a crypto, Ethereum, Bitcoin, one or the other, maybe both, maybe the other way. How much do you turn into USD and how much do you let ride crypto, given that most of your bills presumably are being converted into USD? I guess it kind of levers you to the market in a sense, I guess, and there's probably tax implications too of how and when you convert. So I was just curious about what
So
you guys
I'm smiling because I've been through like the up down cycle of this. Raised a token sale in 2014, at like peak the high, and then 2-3 months later, nosediving down. It was definitely not a fun experience for anyone that did a token sale around that space. Even like Ethereum Foundation, I believe was like 2 months from running out of money. They're shutting down, so just because people were like, "Oh, crypto's the future and it's never gonna go down," and then
Pop.
and you kind of you feel the effects of that. So I highly recommend if people are doing token sales, get some cash, get some euros, get some
Yeah. And there's a
the
good
older
ratio,
stuff.
you know, 70-30.
Whatever people want.
Yeah.
I definitely.
But it's up to you to make that judgment as to how much you would want to Yeah, dollars to tokens.
Depends on how risky you want to get.
It's risk management. At the end of the day, it's no different than if you're a global company and you're dealing in 20 different currencies. You want to figure out, how do I hedge? Do I hedge my bet? How much do I convert to my functional currency where I have demand, which is US dollars, for most companies here in the US? And how much do I hedge my bet in different currencies? And essentially, you think of Ethereum and Bitcoin as a currency that fluctuates in value.
And it seems like there'll be a fairly robust derivative market coming soon. Probably give other people options in managing
There's
that.
so
I
much
believe there
fun
was-
things coming down the line.
Yeah, there was a release about in July about a derivative or a cryptocurrency derivative market. Last question.
Could you talk a little bit about, now you created these wonderful tokens, how you market them? When you have a security, registered broker-dealer, placement agent, how do you market it? And who are the folks out there that help you, and what do they charge?
Well, is there actually do you need a registered broker-dealer because they're not?
Yeah. So
No, we're not.
So are you talking about post token sale or pre token sale? Pre. Yeah, it depends if your token sale is a security or not. If it is a security, obviously you have to follow all the compliance and regulations. If it's a use token, then you're a little bit more flexible in how you can market it. You can market, look, this is a token that you use in this product here, and so it's more you're selling the product.
Is there a middleman?
Yeah. So there are advisors in the space that will help you, I would say, reduce the burdens of doing a token sale. I think a lot of people see them as essentially solving the problems, all of the problems associated with the token sale. I can say that's like completely false.
They do not market your token.
Yeah. So what they do is they give you, for example, Token Mart, they give us, a widget that we could use to essentially accept, the transactions, for the token sale. So we don't have to build that. That would, probably cost us a lot of money and months to build and then audit. But they already have it. So these advisors help, reduce the time, the cost, and complexity because they've done this many times before.
It's all marketing. So we had PR people, we built a community around our Slack. So we saw our Slack grow. Now it's over 1,500 people in less than 60 days. It's really just finding where these people are.
Yeah,
So in addition to decentralizing the actual capital, you've taken your fundraising and marketing component and essentially replicated it 1,500, 2,000 some odd times over your different platforms.
Yeah, so it's one, building an online community around your product or service. And the secondary thing is more traditional, going to the Bitcoin and Ethereum conferences and networking and meeting people who are going to help you, avoid pitfalls and, be, in-depth contributors into your open source community. So just kind of pulling from that space.
So
you
it
can-
is
you can build
traditional, PR marketing
Yeah.
strategies.
It does seem that the investors are more actively looking for you as well than maybe more traditional markets like
You can tell stories.
ICOalert.com. You have a dashboard of every scheduled ICO, and I'd imagine that a lot of the community that's putting money in this probably doesn't let an ICO get by that they didn't at least read a tagline for.
Yeah.
So that's impractical in a traditional VCP world. But given that all the sales are happening over the internet, and there's plenty of aggregators of the information, and people want to know about it and want to hear about these projects, it's a little bit, I think, easier to get awareness than if you're just trying to do it on the street.
Great. And with that, I want to thank our panelists, Mitchell Kopelman, Chris McFarland, Sean Wilkinson, and Austin Mills again for a great evening, great panel. Thank you, ladies and gentlemen, for coming to ATDC.
Come on, jump in there. All right. 1, 2, 3. All right.
Yes, contact information will be available as well as the presentation. Again, thank you very much.
Oh, yeah. Yeah, I was helping come up with this question. Is it possible, I'm working on a report on ICOs. Is it possible to interview sometime?
I'm pretty busy, but if you send me an email,
Yeah, just like maybe do an email and then maybe follow up or something like that. I mean, because what I'm trying to, yeah, what I'm trying to do is I'm trying to kind of like detail the before, during, the after, and kind of take some case studies. And since you're here in Atlanta, you can definitely do case studies. Yeah, I'm fine. I'll just remind you that I met you at ATDC. All right? Thank you. I do. We're working on a study on this. So what we want to do is we want to be able to have resources on it. Yeah. Obviously, we want there's another law firm in town that's doing it also. Okay, which one?
yeah, I'm with you. Yeah.
I don't see it much. You know, yeah, I'm curious. I've become really passionate about putting professional things out. I think it's really exciting. Kind of buy it now. Yeah. It's very skeptical for a while. So there's point being, love to talk about it.
And for us, like, not even talking about that.
Yeah, reach out to me.
ICO part, but for our regular business, it's like from one unified market, which is, you know, like easier to enter than, you know, for example, European market, where there's like slight, like language barrier, the US is just like more united, more similar market, and it's super big. So that's why
What are the steps of the process is about?
exactly, and that's what yeah, but then the question is like, I think it's like, for a US banks, right? Not really?
Let's go, Jeremy. So I was previously a securities regulator, and what I was bringing to recent guidance and like the ICOs, the white paper, I'm like, I use securities. So if a token sale is going to be a securities token, what's the advantage of doing it as a token as opposed to just equity, or just a stock issue, let's say you designate price? Yeah.